When embarking on the journey of starting a business, understanding the various funding options available is crucial for ensuring adequate financial support. Each funding source has its own unique characteristics, advantages, and potential drawbacks, making it essential for entrepreneurs to carefully assess their individual needs and circumstances before deciding on the best route for their venture. Self-funding or bootstrapping is often the first option considered by many entrepreneurs. This approach involves using personal savings, income from a current job, or even funds borrowed from family and friends to finance the initial stages of a business. One of the primary benefits of self-funding is the control it offers. Entrepreneurs who finance their startup independently retain full ownership and decision-making power, avoiding the complexities that can arise from external investors or lenders. Moreover, self-funding can simplify the startup process, as it eliminates the need for lengthy loan applications or grant applications, allowing entrepreneurs to move quickly in bringing their ideas to life. However, self-funding also carries significant risks. Using personal savings means that individuals are investing their own financial security into the business, which can lead to considerable stress if the venture does not succeed. Entrepreneurs must carefully evaluate their financial position and ensure they are not jeopardizing their personal finances in pursuit of their business goals. Small business loans represent another viable funding option. These loans are typically offered by banks, credit unions, and alternative lenders, providing entrepreneurs with the capital needed to start or grow their business. Securing a small business loan often requires a well-prepared business plan that outlines the purpose of the loan, the projected use of funds, and a comprehensive overview of the business's financial forecasts. One of the advantages of small business loans is that they provide access to larger sums of money than self-funding may allow. Furthermore, repayment terms can vary widely, giving entrepreneurs flexibility in managing their cash flow. However, obtaining a loan can be challenging, especially for new businesses with no established credit history. Lenders will assess the applicant's creditworthiness, and entrepreneurs may need to provide collateral to secure the loan. Additionally, the obligation to repay the loan, regardless of the business's performance, can create pressure, particularly during the early stages when revenues may be inconsistent. Government grants are another important avenue for funding, particularly for new businesses that meet specific criteria or focus on particular sectors such as technology, environmental sustainability, or social enterprise. Unlike loans, grants do not require repayment, making them an attractive option for entrepreneurs looking to minimize financial risk. However, securing a government grant can be a competitive and lengthy process. Applicants typically need to demonstrate how their business aligns with the grant's objectives and provide detailed proposals outlining how the funds will be used. The application process can be complex, often requiring a considerable investment of time and resources. Despite these challenges, grants can provide essential funding for startups, allowing them to focus on growth and development without the burden of debt. In addition to these primary funding options, entrepreneurs may also explore alternative financing methods, such as crowdfunding, angel investors, or venture capital. Crowdfunding platforms enable individuals to raise small amounts of money from a large number of people, typically via the internet. This approach can not only provide capital but also serve as a marketing tool, generating interest and validating the business concept before launch. Angel investors and venture capitalists, on the other hand, are individuals or firms that invest in startups in exchange for equity. While this can provide significant funding, entrepreneurs should be prepared to share ownership and control over their business direction, which may not align with everyone's vision. Ultimately, the choice of funding option depends on a variety of factors, including the nature of the business, the entrepreneur's financial situation, and their long-term goals. Self-funding offers control but carries personal risk, while small business loans provide larger capital with repayment obligations. Government grants present a fantastic opportunity, but require thorough preparation and alignment with specific criteria. By carefully evaluating these options and considering their implications, entrepreneurs can make informed decisions that will best support the success and sustainability of their business ventures. Each funding route comes with its own set of challenges and rewards, and understanding these dynamics is key to navigating the complex landscape of business financing.